What's going on, everybody? It's the Fish Hook Trader, aka transferring over to Armored Bull Trading Group. I just want to talk real briefly about the market today and some videos I got coming up for you guys. I've shifted my my Play Robinhood account over to credit spreads instead of debit spreads and other standard calls and stuff like that. What I've decided to do is, since the market is literally on the bull run now, if you follow me at all on any forms of social media or Discord or whatever, you've seen that I've said that 344 is the bull market rerun, right? So we broke 340 again like nothing, tagged 342, 3, 4, boom, there you go, bull market running. We touched 348 today. So again, my projections from last year or early January were that when the market crashes, it will be around 360 to 380. Now that we have unlimited quantitative easing, we have basically the Fed can pump money anywhere they see fit, whether it's bonds, stocks, funds, it doesn't matter. They're just pumping invisible money everywhere, right? The problem with that is eventually hyperinflation is going to catch up to us. Powell's talking, I think, tomorrow or whatever the case. Honestly, trade with your gut, right? So you got things like Tesla, all-time high, SPY again, all-time high, Shopify, all-time high, Apple, all-time high, several other stocks, Home Depot and Nvidia, and all these stocks just booming, right? So I've seen plenty of articles talking about the NASDAQ. When it goes vertical, that is when we need to worry, right? And then the smart people will get out at the top, and then of course all the rest of us, or other ones who aren't really paying attention, will get burned on the way down. Now, I told a lot of people to go cash back before the first crash happened in March. But at the same time, it's like if they just chilled out and stay strong and continued investing at the rate they were, they would have been in a better place now. So what I want to say is that we have to relay properly of the market we have now versus the market we had 10 years ago or so, 12 years ago, 2008, and the 08, 09 crash, and then 2000 dot-com bubble crash, and then before then, and then. We have so many more investors now and traders in general that will just buy and flip stocks, buy just options trading, but they're boosting these stocks so much with buying all these shares at the ask price that it's just ramping them up, right? So all the people who shorted Tesla this whole last year got just destroyed, right? Matter of fact, I even blew up my Play Robinhood account over here because of a Tesla trade, to where just the other day, Thursday, it was sideways 1880. I had 2 contracts, $350 profit, easy money. I was like, man, it's only got 2 days left, man. It's not going to run to $2,000. I had a call credit spread, so that's bearish, for $2,000 and $19.90. All the price had to do was stay under $19.90. We're solid. It was at $18.80. Literally, I added 5 more contracts at 10:45 a.m. By 2 p.m., I've lost the entire amount of the money because the stock price ran all the way to $2,030 or $2,020, and it settled down. After hours, I'm like, man, okay, it's going to sell off. No, didn't sell off at all. They continue, whether it was market movers, traders, funds, whoever it was, they burned that price up and went all the way to 2040, got all the way to 2090. I salvaged $500 out of $7,000, right? So we all make mistakes, no worries. So out of that 500 I had left over, I'm already back at about 1,400, just a couple days here. I want to stick with the credit spreads because I want to see how well I can make them work. I know what debit spreads can do, and one thing I want to touch base on, besides just the market being on probably another bull run, at least to the 360 to 380 range. Yes, that's a $20 gap range on SPY, but the thing is, we don't know when it's going to happen. I really project some heavy issues around election time. We may not know, we may not see that happen. It might crash at random, or it could just continue to 400. We've already seen articles about that as well. But one thing I want to say is, dude, if you have been trading for a moderate amount of time, or you feel like you really understand a group of stocks or one stock or the market in general, to the point to where you have just this intuition of being correct, right? I'm not saying by any means that I'm correct all the time. I mean, if that's the case, I would put everything on red, so to say. But a lot of times when you gamble in the market, chances are the market will bite you. Now, if you follow me, like I said, so I have the Netflix position I had, right? 570, 580 debit spread calls, right? Call debit spread. So I had 400 of them, okay? Total input was $13,000, all right? And I lost this. I made a very bad decision. It's my birthday month. I guess I got crazy. I don't know what was going on in my head. I saw a big return which was inevitable because the price dove down from 575 all-time high, hit earnings, dove down even more, and just corroded down to 450, and then it bounced right back up to 490s. It hit 511 3 different times from earnings, and I'm like, it's gonna break out, it's gonna break out, it's gonna break out. I held a position, and my first instinct before I ever opened that Netflix play, which was at earnings, but I was up $3,500 on the position at close of market. Earnings hits, price drops, market opens next day, I'm down to 3,000 some change. I was asleep at 9:55. I saw that my account pulled back up to 7. I'm like, all right, cool. And then it's going to come back up 510, 515, whatever the case. Get back to around somewhere, because it was 530 at close that day before. So what happened was, my first instinct, regardless of whether I could get a smaller position, was to get a September expiration. Let me tell you what happened today. I've been watching Netflix for a minute now, and as I knew, when it breaks 512, it's running to gap fill back to 530. Today, August 26, 2020, Netflix gapped up from 512, hit 515. Damn sure enough, sorry kids, it hit 530, 540, 546 or 7, I think, was the high today. I looked back at my position of what it would have been worth if I'd have chose the September, and I even cut it in half of what I would have had halfway, because I'm sure the price would have been a little more expensive. So I projected that instead of the 400, I cut it in half at 200 debit spreads, and I would have closed today at $50,000 for a $13,000 position. Now let me tell you why I did not make that money. It's very simple. It's not because I didn't hold a position or sold too early. It's because I did not buy the longer expiration. And I cannot stress this enough to you people that trade spreads, debit spreads, credit spreads, or even naked calls and puts, buy expiration. The premium is not hurting you, okay? Some people are very good at flipping premium. And what I mean is, somebody can look at the charts or whatever news, they jump on a momentum play, they buy 50 contracts or 10 contracts or whatever the heck it is, and they sell it for a 30 or 100 or 300% profit, and they make some killer money, all right? And they do this all the time, and it works, right? If it does work, do it. I don't care if you gamble every single trade. If you constantly make huge returns, do it. But pay bills, pay off your house, pay off your cars. You shouldn't have any debt if you're doing and making that kind of money. Don't forget taxes, because Mr. Government Man will come back to get you, I promise. All right? So, with that being said, the reason I chose the name Armored Bull Trading is because I like to build trades that make sense. They put the risk to reward ratio in your favor, right? They allow you to make a 2 or 3 or 4 or 5 or 20 to 1 return based on your risk, okay? And I've done this, and I'm actually literally recording every single trade now just since last week, after the whole Tesla incident. And so essentially I've lost 20 G's in the last 2 months, right? It happens. It happens to every trader. Now, if you choose to not follow me based on this loss, then you're not a fan anyway. But at the same time, you don't really understand the concept of trading, right? So just because you see or follow somebody who's broadcasting just constant returns and money, big money, that does not mean that you're going to learn how to trade, because you can follow blindly signals and things like that all day long. But when the time comes for you to trade for yourself, and you say, you know what, man, I think Facebook's going to go to 400 tomorrow, and it's at 365 or 375. And you know what? I put my whole account on it. and you got 4 days to expiration, but you're going to bet that tomorrow it's going to happen, right? Because they got all this great news. You put, say, I don't know, 20 G's or 50 G's or $100,000 on this play, and you're wrong, right? Not only do you have to immediately cut losses if you're even 3% wrong, because your options are going to get destroyed, that you will likely blow up your account. Anybody who is a good trader now has easily blown up 2, 3, 4, 5, 10, even more accounts possibly, or just one really, really big one. You know, basically betting on black or betting on red. And the thing is, with earnings, you don't want to trade earnings because of the simple fact that the implied volatility, which is going to be a future video. I have several books in work right now. I have several video ideas that I'm definitely going to do, but I like to have, you know, a lot of information for people in these videos. So I don't like to trade videos. I'm sorry, I don't like to produce videos where I've traded, like I traded a debit spread one time and I made 7 videos after it. No, I've traded easily 100 debit spreads, right? From in the money to out of the money to at the money to long expiration to short expiration, huge positions versus small positions, and debit spreads work, but they are very limited positions. A naked call will grant you easily 10 times the profit that a debit spread position will, depending on how far you're out of the money, how far the price moves, and all this other stuff. The thing that people do not understand about debit spreads and credit spreads is that you must build the value into the spread. Unless you're trading a neutral position to where you're already in the money and there's zero chance of it coming back down, or up, or whichever side you're on, call or put. A credit spread, you generally build the wealth into the spread the same way. However, on a credit spread, you also can have a neutral position to where, say, a stock moves completely sideways for a year, all right, and you're like, man, this stock will probably do this for another 3 or 4 or 5 months or even longer, right? So it's in a range. Not only could you use an iron condor, but you could also use put credit spreads, or AKA a bull put spread, which is a neutral to bullish position, to where if the stock goes up, you're great. If it sort of goes up, you're great. If it moves sideways, staying above your highest strike, you're great. Or you choose out of the money bull put credit spreads, and you are expecting the price to increase. Now, here's one thing I learned, and I'll show this in one of my videos coming up, that when you're doing a credit spread out of the money, you need the price to get to your strikes so you can close and take profit early. B, move a heavy amount into your strike area, or B, surpass that area so you actually take the profit. So Big C, Big Commerce, right? Brand new stock out that's super hot right now. I saw it yesterday at $100, and I was like, man, I looked at this last week and it was like 50 bucks. Sure enough, it's already over 100. This morning it opens up, it shoots to 130. At 129, I think it was, I started opening bull put spreads against it for January, long expiration, for 150 to 155. So these are $500 spread widths. I paid $30 per contract essentially, because that's my collateral, because I'm given $470 on I think my average ended up being right at 400 because I got some high, some low. So I got, I think, 6 against it right now, about $3,000 worth of credit. Now, you receive the credit in your account instantly, but you don't see it because it has to grow into the position. Now, for me, I think I'm in an extremely good position. If I had $10,000, I would literally put all of it on this position because I am so confident that I am right. And I will easily be right between now and January. All right, it's end of August coming up. I have more than enough time, solid 4 months. And Big C already today broke 140s, okay? Dang near 150, hit 149, I think, is some change. All I needed to do is go to 150, 155. Now, what you need to realize with credit and debit spreads is that you need to build the value into the spread. Sorry, let me fix my camera here. I felt like it was off. You got to build the value into the spread. All right, so say my price is 150, 155. Now, you all need to pay attention if you're trying to trade credit spreads and debit spreads. I needed to earn the collateral premium, right? Currently, the price is at 135 to 140, whatever the hell it is. It doesn't matter. I need it to be by around October, November, January. I need it to be above 155. I personally think that BigCommerce will do just like Shopify and run to just the Netherlands over here and probably reach 300 or 400 by next year if the market continues in the same direction. Even if we have another crash, just like we did. I mean, just look at stocks. You could have basically threw your money at any stock back in March, aside the handful few that went bankrupt and dropped to nothingness. That all of them, not only did they double from March lows on March 13 to 16, they also increased even more. Apple never went to a crazy low. It stayed higher, and then it doubled almost, right? Apple is 400 and like 99 or $505 a share now, when just in March it was 350. You almost doubled your money just then to now. It's only August. Other stocks I know that have quadrupled since then. It's all about paying attention. And why didn't I do this, or why didn't this and that? You know, all the gurus will say this, that, and the other. And plenty of haters will say, well, why didn't you just put all your money on that stock, you know, if you thought it was going to double and triple and quadruple? Well, the fact of the matter is you don't know that. I had a few limited positions here and there, Hertz and Intelsat, you know, all of a sudden, boom, bankruptcy out of nowhere. Now, Intelsat I probably could have foreseen a little bit because they had a heavy balance sheet of debt. Hertz was not bad until Corona happened, and then boom, there they go. They went bankrupt. Fortunately, my position on Hertz was very small. It was only $300. Position lost all its value in no time. It was a couple of days, and it went to about 80% loss. I waited a few days. It gathered a little bit back, and I just got out of it. Don't hold on to losing positions. The one thing I've noticed since I've recorded my trade since last week is that the faster I cut a loss, even if it runs a little afterwards, I am okay, because I'm now efficiently using that collateral money to use into another trade. There is always a train coming. You just have to be on it. The thing that I was talking about with debit spreads and credit spreads, building the value into it, there are some people who believe that you should just get in a position and just let it expire. You know who you are. I'm talking directly to you in this moment. I love how you trade. Extremely smart trader if you ever watch this video, but I highly intellectually think you should not recommend people to close spreads at expiration, by expiration, I'm sorry. You should not let them expire. For example, my Tesla position I lost all this money on, right? I was up 350. I added 5 more contracts for a total of 7. My collateral is now $7,000 minus the credit. Credit was very small, so it was only like $700 worth of credit. All right. The position was over $100 away from the money. Thursday, Tesla moved sideways. So I want to go help my son with his schoolwork. Literally 2 hours was all it took. Tesla ran over $100 and washed my position completely out. You know how many days were left to expiration? 1. Thursday, Friday close, done. I would have realized the entire profit of credit, which again was like $700 or $900. But instead, because it moved so far above, heading up to the 2090 range before it broke 2100 in the last few days, just destroyed my whole position. I'm not mad about it. It's my fault. Stuff happens. That's trading. I know I'll make it back. I've already tripled my account in 3 days. And it's not about being cocky. It's about knowing what you're doing, right? I know what trades to get in to produce me money, but sometimes you feel a little risky. Only thing I will say is please don't risk your whole account or your the collateral. Here's my problem with credit spreads. A lot of videos are very misleading on credit spreads on YouTube now. I watched a whole bunch of them last week just to, you know, feel out what people's strategies and, you know, how people feel about them, what they do, what strikes they trade. Do they trade out of the money or in the money or at the money, trying to get the sideways, vertical, or south move. And I'm like, okay, I kind of understand what's going on here. I feel what you're doing. Exercise wise, don't sweat it. Do not kill yourself over, don't beat yourself up over losing money on a credit spread or debit spread. You do not officially lose your money until expiration. One thing you also need to know, especially if you use Robinhood, the premiums on these spreads, credit or debit, they jump around so much. Your position could be negative $1,000 and you only got $100 worth of value in the spread. It doesn't make any sense, but that's just how it is. Maybe Fidelity, TD, and all these are not like that. I don't normally trade these spreads in those unless I know they're solid, right? I don't like to see my money bounce around. Not to mention, if you trade on margin and that happens, they're going to margin call you and you're going to get screwed. You need to allow the spread to run. However, if you need to cut the loss, move on. If you're wrong, you're wrong. You don't want to be wrong when you have collateral at hold. That is my issue versus you. Naked calls, you're risking 100%. Debit spreads, you're risking 100%. Credit spreads, you're risking 100%. However, the cost of the debit spread, the cost of the naked call may or may not be more expensive than the credit spread collateral. However, the collateral that you are putting up, unless it is an out of the money, out of probability trade, which is what I actually like now about credit spreads, because I've done it 3 times now in the last few days and tripled my account. Because it's the projected move against you that is making your premiums higher. Therefore, when you put that in your favor, so now you were so confident you will be in the money or at the money. Guess what? Those premiums are gonna net you up front more. So say it's $100 spread width. So like today I did SPY at 344, 345. Put debit spread or put credit spreads. So bullish position, put credit, bull put spreads. I know a lot of these names get very confusing. It was $100 spread width, so 341. God bless. 344 to 345, $100 spread width. I received $32 credit per contract. I did 8 contracts, so I only put up the difference of $70 times 8, right? However, within 2 hours, I day traded out of this and I collected that premium. I think I earned $115 off of that. I recorded. I don't even know what it was. No, sorry, easy $80. I'm sorry, $80, 35%. I took $80 off the table just like that. I could have held it later today. I mean, hell, spiked to hit 338, and I would have been even more profit. Probably could have sold it for like $5 per contract, or bought back rather, and been in a larger profit position. However, I got into this big C and I just kept pumping the money into it, and I will next week as well, and so on and so forth. Because until, let's say today's August, so September, so October, I'll probably stop putting money into those trades if it's in the same range. Now, if it already blows up to $185 or $200, I'm saying, like, I have a lot of confidence in Big C right now. It's not just a hype stock. Big C can literally be the next Shopify, right? Because I've used their platform before and I actually really enjoyed it. I've used Shopify before. Shopify was very in tune to all these other programs, but Big C was very easy to use. It really was. So I feel like their customer base can be very good. I don't know about their ad revenue and all these kind of things, but you know, it is what it is. My point is, if you choose to let a credit spread or debit spread expire in the money, you better hope to Betsy that it literally expires in the money for your total strike width. Because on a debit spread, those 570 to 580 Netflix calls I had, guess what? 400 of them expired at 0, the entire amount of money. Because guess what? On certain option contracts, you cannot get out of them if there's no buyers, or if you're selling it and there's no buyers, or if you're buying it and there's no sellers. What are you going to do? You're screwed. You can't get out of the position. The same thing happened with Tesla. I couldn't get out of that. I couldn't get out of that for even $2,000 or $3,000 that same day. Now, maybe a week or two prior to that, when the move, you know, hadn't occurred yet, and I'm collecting all this beautiful premium. What my mistake was, not only when Netflix was not choosing my original gut instinct of September, long expirations, people. You will get burned by that short expiration stuff, and I promise you, eventually you'll change your mind. But it's going to take something really hard to hit you for it to happen. Because a lot of people like Trey. I know a guy that just traded. He had Facebook. He's like, and you know who you are. You watch this video. I'm sorry, I'm not saying your name, so you know who you are. I already mentally told you this in person and through contact. But I looked at the charts. The charts are bullish. The thought of losing the money was strong. So you either will lose the money or you let it ride. So he opened a Friday expiration on a Monday. So he had Monday, Tuesday, Wednesday, Thursday, Friday. Monday is when it happened. It dipped. All right. I looked at the chart. I'm like, dude, you got till Wednesday. Make a decision by Wednesday. That's when you need to sell, or take a loss or take profit, whatever the case be. At that point, he was down a pretty good amount. I think it was around 50 to 60% of the trade value of a several $1,000 trade. And I'm like, dude, just hold it out. I looked at the charts. All the Facebook charts are bullish, right? And now this is not hindsight. This is not hating on him or anything like that. But your mind is in control of what you were doing when you were trading. Until you control your focus on your psychology factor, you will make mistakes. You will lose money. You could make a lot of money. But the problem is, had he held today, that mere $6,000 cost position was $40,000 2 days later. All right? Today, Thursday. Facebook dang $302 or $3, and he sold at $273 for a loss of, I think, $2,000 or $3,000. There it is. My Netflix position, had I put my September expiration, would have been 80 grand at minimum. 50, maybe minimum 30,000. I would have been like, get out. I'll take my profit and run. But you cannot let a position run if you don't have the time. Expiration is important. All right. I'm sick and tired of telling people this, and even to the point to where I stopped following my own advice, because it's like, dude, when you trade short, you're gambling on calls or any type of bullish position. Unless you're so confident 100% that you are not wrong, do not trade a short expiration. Puts is a slightly different scenario. With puts, you want time on your side. So you need around 2 months or less, but not less than a week or two, because if it jumps on you, you're screwed. You're going to lose all your premium value and you're going to lose the money. You want theta on your side. Do not trade things that you don't understand. Don't trade credit spreads if you've never traded credit spreads. Don't trade debit spreads if you've never traded debit spreads, unless you're losing a very small position of your account. $100, $200. Hell, I've opened a spread for $15 before. Debit spread or credit spread doesn't matter. Do not put yourself in those positions. Don't let trades expire for nothing. Don't let them expire at zero. Don't let them expire at 90% losses. Don't let them expire, period. Just close the trade. Why are you going to hold the trade open for another day? Do you know how much premium was left on my Tesla position that I waited? $35. I was sure that I was going to be in the money. Sure it was going to be in the money. I was good. I was going to close Thursday. No problem. Guess what? Lost all of it. Almost $500 worth. The other thing I want to say real quick about the expiration thing is that if you're letting your trade run and you have this massive profit, but you're under 25,000 and you're on a regular standard PDT, you're not on a cash account or whatever, what do? Do you close the trade with your exceptional account and your huge profit, or do you let it ride? Because you don't want to throw your day trades out. You want to expire. Okay, so what if next day it happens and you lose it? And you lose it, right? What happens? You just lost all your money. You could have locked your account. People are so confused at the idea that if they lock their account out, they can't trade anymore. Now, for 90 days, you will lose your ability to pattern day trade unless you have 25K or more. Excuse the background noise. But otherwise, close it. It's okay. I think I hit my time limit here. Hopefully it's not separating my video. Anyway, have a good day, guys. Hope this helps somebody. Have a good one.